Hey everyone, welcome back to Corporate Decoder, the place where we unpack financial documents so you don't have to. Today we are diving into the prospectus for Pomona Investment Fund. And let me tell you, sometimes the simplest sounding names hide the most complex investment strategies. You did not want to miss this deep dive into private equity and how this fund aims to deliver long-term capital appreciation. Before we jump in, if you appreciate getting straight insights from these corporate filings, make sure you hit subscribe so you don't miss out. Also, if you want to discuss these findings with a community of like-minded investors, join our Discord server, linked in the description below. Let's start with the basics. Pomona Investment Fund is a closed-end investment company designed to give investors access to private equity. Think of it as a fund that invests in other funds that in turn invest in private companies. This is not for the faint of heart, folks. It is considered a speculative investment and you could lose your entire investment. Their main goal is pretty straightforward: long-term capital appreciation. They want to make money and grow it over time. Now for the nitty gritty, the money side of things, if you want to invest in Class A shares, you could pay a sales load of up to 3%. This is essentially a fee you pay up front when you buy the shares. The bigger your investment, the lower the percentage of this fee can get. For example, if you invest less than $99,999, you pay 3%. But if you invest $5 million or more, well, then the sales load is 0%. Smart money plays the long game and gets better rates. And then there is the early repurchase fee. If you decide to sell your shares before you've had them for a full year, the fund will charge you an extra 2% fee. This is to discourage short-term trading and encourage long-term commitment. It also means that if you need your money back quickly, you will pay a penalty. The fund has administration fees to Pomona Incorporated and Colmore Incorporated. These are ongoing costs of running the fund. They are calculated as a percentage of the fund's net asset value each quarter. So as the fund grows, so do these fees. This part sounds complicated, but here is the gist. There is an agreement to limit the fund's operating expenses, excluding certain specified costs, to no more than 0.5% annually. If expenses go over this limit, the advisor Pomona Management LLC will cover the difference. But here is a catch: they can recoup these waived fees later if expenses fall below the limit. This is standard practice, but it means the advisor protects their bottom line too. Now for the really interesting part, the fees within fees. Since Pomona Investment Fund invests in other investment funds, these underlying funds also have their own management fees and incentive fees. Typically, these other funds charge a 1 to 2% management fee plus about 20% of their profits. This means as an investor in Pomona, you are paying fees on top of fees. This is a common feature of private equity funds, and it is important to be aware of the double layer of expenses. This document is a filing with the SEC. It tells us about the fund structure fees, risks, and how it operates. The fund offers Class A shares and Class I shares. Class A has that sales load we talked about, while Class I shares are offered at net asset value with no upfront sales load. The minimum investment for both classes is $25,000. This is a significant amount and shows this is aimed at more sophisticated investors. Pomona Investment Fund is raising up to $1.5 billion. This is a substantial amount and suggests they have a clear deployment strategy for this capital. The core investment strategy revolves around private equity. They primarily invest in secondary and primary investments in private equity funds, and also some direct investments in operating companies. Pomona Management LLC is the investment advisor. They have been around for over 30 years and manage a massive portfolio of around $19.7 billion. They seem experienced and have a good track record in private equity. They focus heavily on secondary investments. This means buying existing stakes in private equity funds from other investors. The idea here is to potentially bypass the early stage losses known as the J-curve that primary fund investments often experience. It can also mean quicker distributions and less volatility compared to jumping into a brand new fund. They also engage in primary investments, which is investing in new private equity funds as they are launched. This usually means committing capital that will be called over time. Direct investments involve buying stakes directly in operating companies. This can be done solo or with other investors. It bypasses the layers of fees found in investment funds, but carries its own set of risks in managing those companies directly. The asset allocation targets are quite telling. They aim for 50 to 100% in secondary investments, including early secondaries. Buyouts are a significant part of their strategy, targeted between 50 to 80% of their investment opportunities. Looking at the projected expenses with a 5% annual return, the example suggests that for every $1,000 invested in Class A shares, you could pay around $68 in fees in the first year. For Class A shares, it is closer to $34 over 10 years. That difference adds up significantly. This is why choosing your share class and understanding the fees is crucial. The fund uses leverage through a credit facility with Barclays. As of the 31st of March 2024, they had $93.2 million outstanding. This leverage can magnify returns but also losses. The senior securities section shows how the fund uses debt. The asset coverage per $1,000 of indebtedness is quite high in recent years, staying well above the required thresholds. This indicates a healthy buffer. When you add up all the fees for Class A shares, you are looking at around 3.93% annually, and for Class A shares about 3.38%. This is high but not unusual for private equity funds which require more specialized management and due diligence. The acquired fund fees and expenses are a significant chunk of this at 0.89%, reflecting those doubled up fees we discussed. There are also commitment fees of 0.06%. These are fees paid to secure capital commitments in investment funds. This is typical for private equity strategies where the fund locks in capital for future investments. Now let's talk risks, and there are plenty. The most significant is the risk of losing your entire investment. This is not a get-rich-quick scheme. The market for secondary investments is not well developed and may not be liquid. This means it could be hard to sell your stake if you need to. Valuing private equity stakes is inherently difficult. Since these aren't publicly traded assets, their worth is estimated. This estimation process has inherent subjectivity and potential for adjustment not always in your favor. The fund has no obligation to repurchase shares. Any repurchases are at the board's discretion and may be limited. This means you might not be able to get your money back when you want it. Pomona is a non-diversified fund. This means they can invest a large percentage of their assets in a single company or fund. While this can lead to higher returns, it also means higher risk if that one investment goes south. They intend to qualify as a RIC-regulated investment company for tax purposes, but failing to meet strict income and diversification rules could mean the fund gets taxed as a regular corporation, losing out on tax advantages. Also, dealing with the tax implications of investing in foreign companies and partnerships can be very complex. The core of this fund is its advisor Pomona Management, LLC. They have a robust global platform and a team with extensive experience in private equity. Their ability to source deals and manage risks is what the entire fund hinges on. The fund may offer to repurchase shares quarterly, but this is not guaranteed and is subject to the board's discretion and the fund's liquidity position. This provides a limited escape hatch for investors, but it is far from a daily redemption. So what is my take on Pomona Investment Fund? They are clearly playing in a high-risk, high-reward space. Private equity offers the potential for outsized returns, but with that comes significant uncertainty and illiquidity. Their focus on secondary investments is a strategic choice to mitigate some early-stage risks. However, the considerable fees both at the fund level and within the underlying investments are a major hurdle. You need substantial returns just to break even after costs. The limited repurchase offers and the speculative nature of private equity mean this is only suitable for investors who can truly afford to lock up their money for extended periods and withstand potential significant losses. Their extensive risk disclosures are not to be taken lightly. Alright, that is our deep dive into the Pomona Investment Fund Prospectus. Do you think the potential rewards of private equity outweigh the risks and fees here? Let me know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more. And don't forget to check out our Discord community linked in the description for more investor discussions. Thanks for watching. See you next time.